A couple of interesting things this week, Mickey. The Fed didn't raise rates, and then you had the Trump administration put out an executive order of their intention to lower taxes. That seemed to make the market go up. Did you see it the same way?
Yeah, I mean, the market's always looking for good news, and both are great things in the market. Obviously keeping interest rates low will keep money flowing into the market because that's how people are going to get return. And lower tax rates, always a good thing for everybody because it's going to mean more money for investing. So both are good things for the market.
I guess the question then is, do the fundamentals change? Is there enough buying power for the future? Is there enough in just declaring the intent without necessarily the specifics on how the tax reform is going to occur, how that's going to mean for deficits, what that's going to mean for spending? Is that enough to keep the market going for a while?
One of the things that's pushed this market up has been a lot of trading. There's a lot of money on the sidelines, and there has been for the past really couple years. And what happens is every time we get this push up higher, you get a little selling. And when you get a drop in the market, all this trading money comes back in. A lot of this black box, algo, high frequency trading comes in and pushes it back up. So there is a lot of money in the sidelines waiting for dips, people buying. You have a lot of investors in the sidelines that are always love good news. They love going through 20,000. They jump in, kind of the last one holding the bag. So for right now, there is money on the sidelines. There is money looking to buy things. So the momentum is still going to the upside. At some point, that's going to change, but we need something that pushes us to make that occur, which there's nothing out there right now that is going to do that.
Let me challenge you on that for just a moment. You had talked in previous segments that essentially the price to earning ratios are pretty high. In other words, the value that is being placed on stock right now is high, so the potential for returns long term aren't as good as maybe in years past. At what point does that tip?
Well, that's a really, really valid point. And we're talking more about the trading side right now. The investor side, the long-term side, they're definitely looking at that. But what's pushing the market up right now is more of this trading atmosphere, this high-frequency trading, which is 70 to 80% of the volume lately. When we get these market drops where people come flying into the market and buy, when Apple drops 10%, they come in and buy it, and then it runs back up and they sell it. They're not looking at these price earnings. They're looking to make quick money, and that's helping to pop the market, get these quick pops in the market. And right now, we're kind of in this shorter-term approach to the market. So from what you're saying, you're right. The price earnings ratios, you have to look at those for the long term. We are at the higher end of the range. But the shorter-term approach we're looking at, this market has a lot of upside momentum, and we're not going to be dropping anytime soon unless we get something that pushes us the other way, which there isn't anything out there as far as I can see. So people are kind of disregarding these valuations to look at the short-term money that can be made. As an investment advisor, I take that into consideration when I'm looking for my clients and saying, yeah, the market's going higher, but we also have to look towards the future and what's going to happen. And there's a balancing act from my end to take both scenarios into how I'm managing money. So it is tough. And for the investor, it's a really tough situation right here because you feel like you're missing the boat when the market goes higher. But at some point, going back to your original question, this is going to turn. I mean, nothing goes up forever. We saw that in 2000 when everyone thought the tech bubble was going to keep going forever. And then all of a sudden, NASDAQ went from 5,000 to 1,200 in a year. So it is a tough scenario, and it's really hard to give a straight answer because there's so many different parallels to this question.
I think then the question to follow up with that with you is, what are you advising clients right now?
The thing I've been advising my clients all along is kind of twofold. One, we stay the course, but two, why we're staying the course, we've also been kind of moving a little more from an aggressive tone to a slightly less aggressive. If clients were, 85-15 stocks bonds, they've been down to 75-25, just dropping a little bit from stocks to bonds because that change in percentage can be a big help when markets drop. Still, the trend is still moving higher, but at some point things will change. I'm not sitting here trying to time the market because we all know that's a fool's game. But you have to start looking at valuations, at historical bull runs. We know at some point this will end, and moving 10% from stocks to bonds, on the upside you lose like 1% gain. On the downside you gain almost 4%. So it's worth the adjustment, and we're still staying with that, aggressive bull market approach. But it is tough. For me to do my job is tough, trying to explain to my clients why I'm making moves when all they see is the market going higher. And then when it does change, then they're like, oh, thank you.
Well, you got the tough job, and I'll pay you good money to do it too. I appreciate your insights. In the meantime, if other people want to get insights from you, how do they get a hold of you?
They can email me directly, Mickey, Mickey, at Envestim, ENVESTIM.com. They can follow us on Facebook, our Envestim page, and also on Twitter at Envestim1.
Thanks, Mickey. Good stuff. We'll talk next week.
Sounds great.